Money FM 89.3. Best of breakfast. The bigger picture, only on Money FM 89.3.
Good morning. Welcome to the bigger picture. And we are zooming in on the MAS. The Singapore Central Bank has eased its monetary policy settings for the first time since 2020 as price pressures show signs of abating. The Monetary Authority of Singapore, which uses the exchange rate as its main policy tool rather than interest rates, says it will reduce slightly the slope of its policy band, and there will be no change to the width of the policy band or the level at which it is centered. So to break down what all that means, we've got Chang Wei Liang. He is the FX and credit strategist at DBS. Wei Liang, good morning. How are you doing today?
Hi, and good morning, Ryan. I'm good. So we know that MAS have moved by reducing the slope of the senior policy band. So expectations going to the event were already leaning towards a slope reduction. So the move was not a surprise, given that senior has already declined from the top end of the band towards the midpoint of the band prior to this decision.
Yeah, well, unpack what's going on here with the context of the economy, price pressures, inflation. Why has MAS decided to do so now?
So looking at the statement, MAS grounds this decision on two things. First, it has noticed a marked moderation in the pace of inflation. Secondly, MAS is also taking a precautionary move given the rise in global economic uncertainty, particularly with regards to potential trade policy frictions, given the new Trump administration's, I would say, focus on trying to level the trade playing field in trade. So by and large, the inflation forecast from MAS has been lowered. So it's expecting core inflation for 2025 to average between 1% to 2%, and that's down from 1.5% to 2.5% back in the October meeting. So on the price pressures front, even if there are external cost increases from potential trade frictions, this could be offset by weaker global demand. At the same time, on the domestic front, unit labor cost increases could be slowing this year as nominal wage growth slows. So by and large, MAS also expects Singapore growth to moderate slightly over the course of the year as the impact of changes in trade policy weigh perhaps on domestic manufacturing and trade-related sectors. So overall, this move, I would say, is a well-balanced calibration given more uncertainty in Singapore's inflation and growth outlook.
Yeah, it's a tough balancing act here because you've got so many moving parts as you've outlined. You've got the tariffs. We don't know exactly to what extent it will be and how it will play out because it could potentially be higher prices and then raise inflationary pressures again. How do you see things play out for the rest of the year with that in mind and, of course, the global economic backdrop?
So in our view, dollar Sing could be heading a little bit higher because of, as you have mentioned, risk of trade frictions, we have tariffs. So interestingly, President Trump, yesterday at the Davos, said that he's actually looking to level the playing field for trade. So he's pretty open to trade negotiations. He had a call with President Xi earlier, before his inauguration, talking about trade, TikTok, other related issues. So there's some hope that he might refrain from imposing tariffs, even though he has threatened to do so on February the 1st, to impose a 10% tariff. So there's still some scope for negotiations. It's not necessarily a bad outcome. But given the fact that so much attention has been focused on tariffs, to demonstrate some commitment, we could see some volatility in terms of the news headlines. So there's definitely going to be, I would say, a little bit of a precautionary demand for dollars given this high uncertainty in a global trade policy environment.
Yeah, there's been some talk about how rates in the US will stay higher for longer. That's given some strength to the US dollar. And just taking a look at the dollar, Sing dollar cross, we are now at 1.35. And that's on the past year up about 1%. Do you have a level you're looking at in terms of the dollar, Sing dollar cross in the coming months?
So dollar Sing, we're expecting 139, and that's largely conditioned on a rise in the dollar. So we are taking a more cautious stance in terms of our forecast. We think trade policy is going to get worse before it gets better, and there's going to be a lot of uncertainty that could drive the dollar. So as you mentioned, yes, U.S. interest rates have repriced higher, largely because markets are expecting some sort of tariffs, and tariffs, as you know, is inflationary. It's going to be making the Fed's job difficult in terms of managing inflation, and that could potentially mean that U.S. rate cuts will not be coming through as much as what people are expecting just 2 or 3 months ago. So that's likely a small boost for the dollar on top of the existing uncertainty over U.S.-China trade relations.
All right, switch tracks to Japan, where it's also going to be in action, the Bank of Japan. And we are also looking at consensus, expecting them to make some moves. The BOJ expected to push up borrowing costs. There is going to be a bit of a challenge, I suppose, for Asian banks to keep in lockstep with the Federal Reserve. What do you expect the BOJ to do, and what's going to be happening in the coming quarters as well?
Right. So BOJ will be holding its policy meeting today. Markets are completely expecting a 25 basis rate hike already. So if a rate hike does come through, that's not necessarily going to mean the yen is going to strengthen a lot, as happened in July last year when there was a big unwind carry trades. Markets are a lot more well prepared. But at the same time, markets will look at BOJ's new inflation forecast that are to be released today and assess what the risk of another rate hike, perhaps as early as July. So if you look at the Japan's CPI number, the inflation outlook has firmed. CPI shows inflation picking up to 3.6% year on year. That's up from 2.9% in November. And part of this, of course, is due to the phasing out of subsidies. So there's a higher energy cost element to it. But by and large, core inflation has also remained quite firm at about 2.4% year on year. That's excluding food and energy. So that means that DOJ, depending on how trade policy evolve, depending on how wage negotiations, annual wage negotiations in Japan evolve, they could still be looking at another rate hike after today, the main driver for dollar yen.
All right, lots to look out for on the currency front. And of course, the Federal Reserve will be in action next week. What do you expect to come up from the FOMC's rate meeting, and of course the pace of what they might telegraph for the coming meetings?
Right. So by and large, markets are not expecting the FOMC to be a surprise. The Fed has already said they'll be slowing pace of rate cuts. So there's no likelihood of rate cut for January, given the fact that there's still uncertainty over the pace of inflation with tariffs and so forth. But there will be a lot of focus on whether or not there could be a chance of a hike towards the middle of the year in June, given the fact that inflation, the most recent inflation print in the US has been quite well behaved, and if trade policy does not yield too much of a surprise, the Fed could still open up scope for rate cuts. That's one aspect that markets are very uncertain about, which is how the implementation of tariffs could be coming through in the coming months.
All right, no rate cut expected in the next meeting next week, but perhaps some signals on when we could see one, perhaps in the middle of the year. We've been in conversation with Chang Wei Liang. He is the FX and credit strategist for DBS, helping us to unpack the latest decision from the Monetary Authority of Singapore to ease its policy settings for the first time since 2020. Wei Liang, thanks for your time this morning and your insights.
It's my pleasure. Thank you.
All right, catch up with you again soon. Stay at Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.